Zealand, and I'm joined by Jason Choy, who's a Senior Portfolio Manager for InvestNow. Jason, just while we wait for people to come in, was telling me he was all excited because he was actually watching Parliament TV, I think you're saying, Jason.
First time.
For the first time, lies. You probably watch it all the time. Because they're actually doing the reading of the bill, or the second reading, is it, Jason?
Third reading.
Third reading. And final reading of the bill that actually creates the changes that we're talking about today. So literally the issue that we're talking about at the moment being the changes in tax rates for family trusts is passing through the House. And obviously it's a really interesting topic. We only have to look at the attendees that we've got today. We've got both investment advisors, investors themselves, tax specialists, and accountants all coming along to hear about the changes and what we see it, our view on what it means for investors who are operating family trusts. Now, the focus today is very much on family trusts that are holding discretionary investment assets like shares and bonds and term deposits, as opposed to those family trusts that still hold things like farms or business assets that are holding. So it's really focused in on those discretionary investment assets. And we think, and we'll take you through our logic for it, that the changes that we're seeing from 1 April in terms of the tax rate, where the trustee income tax rate jumps to 39%, will have a significant effect on the landscape of how these trusts invest. We see them moving rapidly into investing in PI funds, moving away from investing directly into shares, bonds, and term deposits. And that really reflects the significant tax benefits that they can get. Failure by family trusts to act and change their portfolios will have a meaningful impact on the actual net of tax returns that those entities receive. Now, just by way of housekeeping, you can fire questions through as we go along, and we'll pick those up. We'll probably pick them up at the end. And also, there will be a recording of this presentation, which will get sent out to everybody who's attending. So you'll get a copy of it. So if you're surfing between this and watching Parliament TV, like Jason probably is, you won't miss out on anything. In terms of one of the questions, does this extend to things like rental properties and things in real assets? No, they would be taxed if it's trustee income as real assets. But these tax benefits extend to things like property where it's held through a PI fund, like an investment fund that's investing into either listed or unlisted property. But yeah, and so Jason, why don't we get into it? And why don't you take us through the changes that we're seeing in terms of the tax rates and things?
Yeah, cool. Thanks, Anthony. Hopefully you guys can all see these screens. Just seeing out if not. But yeah, so as Anthony's kind of stated, probably the headline grabber is obviously the big change is in the trustee tax rate, which is set to increase from 33% to 39%. So this would apply to all income that is retained by the trust, otherwise known as trustee income. So based on the current legislation, this 39% tax rate will be applicable to those trusts that have a net income, as in net of all expenses, of $10,000 or more. There is a de minimis exception, and this is why I was kind of watching Parliament TV. So they introduced this only at the second reading, and they're going through the third reading today. It's a quite an interesting bill as well. It's not just covering this trustee tax stuff. It's also the same bill that will reintroduce the interest deductibility on rental properties, which I know a lot of Kiwi investors are eagerly waiting for. So fingers crossed, hopefully by the end of today, this will all be set in stone. But yeah, assuming no issues, essentially what this legislation will implement is a de minimis exception. So if you're a trust that earns less than 10,000, you'll still be taxed at the current 33% rate. But if you're a trust that owns 10,000 or more, you will now be taxed at the 39% rate. And this is an all or nothing type rate rather than a progressively applied rate. So what that means is that if you have 9,000 trust income, you would capture the entire 9,000 at 33%. If you're at 11,000 in trust income, then you capture the entire 39% rate. So it's not how like our income tax rates are calculated, which is progressively applied. This is all or nothing type deal. So, as I kind of stated earlier, assuming no issues with the bill going through as a final piece of law today, then this is all scheduled to come into effect on 1st of April 2024. So these new rules will apply, coinciding with new tax year. So, not too far around the corner, really. It's just after the Easter weekend, right? So, Anthony, do you want to maybe give us a bit of background on trusts and taxes? Because I know this is certainly something that's near and dear to your heart, right? You've been looking at this quite intimately within your own trust.
Yeah, and I know there's been a few questions already from people like Barbara and Mark around streaming incomes to beneficiary and things. And this is what was going through my head in terms of my own family trust in recent times is, was I doing this stuff right? Because I was investing the family trust into pie investments because I like pies. They were getting taxed at 28%, which is materially lower than the 33% tax rate that applies to trustee income. Because of pie as a final income. We'll take you through that in a bit more detail in a second. But I always had this nagging question, would have I been better to be distributing income to my beneficiaries who are sort of like late teenage, early adult kids of mine? Would have I been better to being distributing income to them to be taxed at their marginal tax rate? And so I'd scratched my head about that a lot. And then looking at this with the change to 39% tax rate, I finally got how the rules work and some of the changes that have been made in recent times. And a big change that's aligned to this, which I think took back place in about the 2020-21 year. Or firstly, let's step back. When the trust earns income, it can be taxed in one of two ways. Either the income can be distributed to the beneficiaries, and that's notionally or in actual distribution terms, to be taxed in the beneficiary's hands. So that's one treatment for it. And that's always been quite attractive to family trusts, where they say, have someone who doesn't work, who has no normal income. You could be transferring beneficiary income to them and taking advantage of their lower tax rate. And so a lot of trusts in the past have done that. The other way that tax works within a family trust is you could retain that income inside the trust or have it taxed as trustee income, where it's taxed at the trustee tax rate, which used to be 33%, from 1 April goes up to 39%, right? Now, in terms of that beneficiary income, there was a fascinating step that was introduced in 2020, I think, 21, where the new trust reporting requirement says that if you distribute income to a beneficiary in a family trust, then you need to tell them you've done that. But more importantly, they need to know that if it's still within the trust, that it is their income and therefore their asset going forward, and they're entitled to it, right? And so when I thought about that and I thought about my own family trust, I thought, well, actually, I think, did I really want to be distributing income, say, to a 21-year-old beneficiary who's still at university, where I have to tell him that that income is there and that he can get it, and it's rightfully and legally his. Now, it's interesting because I think that would create all sorts of issues inside that, and so I think what we've seen, and we'll show you evidence of this, is that a lot of trusts now have stopped distributing to their beneficiaries or reduced the amount they're distributing to beneficiaries and having that income taxed inside the trust at the trustee tax rate, which is 33%, currently about to jump to 39%. And so why don't you take us through, Jason, what we saw as a result of that. Like this is a change to how you disclose beneficiary income to those beneficiaries. So what happened next, Jason?
Yeah, so like you said, Anthony, so in 2021, with these new trust tax disclosure rules, what we saw is trustee income skyrocket around 50%. So in the 2020 tax year, we only saw about 11.4 billion of trustee income, but then the following year we saw 17.1. So a massive increase. And to Anthony's point, a lot of it is going to be attributed to the fact that people don't want to be necessarily, you know, allocating this income to the beneficiaries, because essentially once it's there, then they have full entitlement to it. So by retaining the trust, that means that they're simply going to be taxed at the trustee tax rate. So within that 17.1 billion, there was roughly 177,000 trusts that made up that total amount. So it seems like quite a lot, but of those trusts, the vast majority basically have nothing in there. And that's just reflective of the fact that a lot of family trusts just have, for example, the family home or business. They don't really generate any income. So within that kind of 177,000 trusts, the top 25% of these income producing trusts, or just 44,000 trusts, accounted for 98% of the trustee income generated, so around 16.7 billion. So just a quarter accounted for basically all of the trustee income. So what that means is within this kind of top 25% of income producing trust cohort, the average trustee income they generated per trust was close to 400K, so 380K per trust. If we go even further to just the top 5% of income producing trusts, or just 9,000 trusts, they accounted for a massive 80% of all trustee income, or around 13.3 billion. So within this top 5% cohort, they had an average kind of trust income of 1.5 million. So these are massive figures, for just a very small proportion. So if you're kind of within this cohort, then your ears should kind of perk up, because these trust tax rates are going to mean a big impact on you. The Finance and Expenditure Committee, so the committee that's kind of overseeing this bill, estimated that this 39% tax rate will impact roughly 49,000 trusts, which generate basically all the trusts in New Zealand. So if only 49,000 out of the roughly 400,000 trusts would be all your trustee income. Anthony, do you want to maybe walk us through like what some of these figures actually mean?
Yeah. And as we go into that, well, why don't you cover this off? But probably the thing to highlight, Jason, is the parliamentary thing that you've been watching on TV is interesting, but of little consequence in my mind, because the $10,000 threshold is basically immaterial, because
Yep.
where the money sits in those 44,000 trusts have got all the income, is what your point is, right? So I think in terms of income producing trusts, there'll be very few who benefit or are even affected by the $10,000 threshold. It's just lipstick on the
Exactly.
thing for political reasons.
Yeah,
Yeah.
if you
So
basically made zero income and your rate went from 33 to 39, you're still paying
yeah,
roughly zero in tax.
yeah.
So you're
But why
right.
don't you
But
talk us through the math here on this slide, Jason?
yeah, so
You're
basically,
better at maths than me. I got a 4 mark and that stuff.
because I'll quickly run through, just given the quantum of these changes. So what can you as a trust do to cushion this blow? So like many things in life, the answer is pies. So by shifting a lot of your discretionary investments into portfolio investment entity funds, or pie funds, trusts can avoid the full force of this new 39% tax rate. But not only that, they can also reduce the overall tax obligation altogether. So this reflects the tax efficiency of pie funds. So the key benefits being, within pies, you have a maximum tax rate of just 28%, versus a 39% maximum for trusts coming in very soon. Pi is also a final tax. So what that means is all the tax obligations are taken care of by the fund itself. So there's no additional obligations required from the trustees or the beneficiaries. And then every subsequent distribution or allocation to the beneficiary is already net of tax. So there's no additional thing you need to take off there. And then finally, within pie funds, you can get so many different pie funds these days that cover a broad range of core assets. So from shares to bonds to property to cash. So pie funds can more or less provide trust with the same core exposure to the assets that you may already be invested in, whether it's kind of like Tesla stock, Apple stock, term deposits, bonds. A lot of these investments you can already get a nice convenient pie wrapper. And the key benefit with that is, basically the difference between a 39% and 28% tax rate would be a 0.55% per annum tax saving. So how we kind of arrive at that is if we kind of assume a 5% return on a 39% tax rate, that means you're taxed at nearly 2% of your trust assets every single year, versus a pie, which is just 5% return at your 28% tax rate, just 1.4. So 0.55% per annum doesn't seem like a massive amount, but if you kind of extrapolate into some of these figures, you can see that this is actually a huge difference, because a non-pie or a direct investment is essentially paying a 40% higher tax bill. And Anthony will kind of walk us through the numbers there.
That's right. I get the glorious thing of having the real dollars and tying it back to the reality of these trusts and their income and things. So remember, we took you through the fact that the top 5% of trusts accounted for something like $13 billion of $13 billion of trustee income. So that's just income retained in those trusts, right? So if you take the 13 billion odd divided by 9,000, these top 5% of trusts are earning on average $1.5 million of trustee income. So simple math says tax that at 39%, you're paying $585,000 of tax. Put it in pie funds, as Jason said, the pies are taxed, it's a final tax at 28, you're paying $420,000 of tax. That's a difference of 165% in terms, sorry, 165% is not a big number. It depends what you put it over in dollar terms, I guess, but it's $165,000 in terms of tax saving from that. And so that's really significant and real, right? Because these are real numbers coming from the IRD. The top 25% of trusts are producing on average $380,000 of income across those 44,000 trusts that Jason mentioned. So their average tax bill at 39%, 148,000 roughly. At 28%, it's 40% less. At 106,000, that's $41,000. So these are material big numbers that people just can't be seen to ignore if the structure of the trust means that they can benefit out of moving into pie funds. So as the slide says, investing into pie funds can sidestep a 40% higher tax bill inside it, right?
It's worth
And so
highlighting as well, Anthony. It's not just a one-off, saving. Is
this is
every
every
single
year, right?
Yep, every single year you get taxed this amount. So if you chuck it into a pie, you're saving, between 40 to 165,000
Yeah,
every
yeah.
single year.
And to note, these aren't make-believe numbers, right? These are numbers taken straight out of the IRD zone um, information that produced in the lead up to this bill going through the House. So these are IRD numbers that we're using inside of here. And so it's interesting because there will be a number of family trusts that still have things. I know one of the question was, what about a family trust with two retired or a retired couple? Surely that'd be better to make beneficiary type distributions. Yeah, that may be the case if that trust, in my mind, if the trust had less than about $2.5 million in it, it probably wouldn't be generating enough income. And it had just retired beneficiaries it was distributing to, that probably would be a good scenario. But a lot of these trusts have materially more by way of assets. I think I worked it out. The trusts on the left being the top 5%, in my mind, as a rough guess, have probably got somewhere close to $30 million of assets. The trusts on the right probably have got on average somewhere around closer to about $8 million of assets. So that's sort of more of a typical, if you believe in averages, and averages can be dangerous, they're more of a quantum of the numbers we're talking about. Now, I'd like to acknowledge these figures include those trusts that own things like real businesses and farms. So some of those top 5, or some of these numbers will be obviously, averages will get distorted and things because of that. But the key thing is this is a material area and this is a big change. I actually think this is one of the bigger changes I've seen coming into investment markets in recent years, just because of the magnitude of these 44,000 trusts in an investment sense.
Nice. So might just quickly close off on our prepared slides, just to, note that InvestNow does provide trust accounts that can help you guys. So within our trust accounts, you can set up the specific member access rights, whether you're a trustee, beneficiary. You can kind of set up how many authorizers or viewers you want, how many approvers you want within your account. And then once you have an InvestNow Trust account live, then you get access to the exact same great investments like every other InvestNow account does. So over 150 different PI funds in there. And you can kind of rest assured that your trust assets are well protected, given we use institutional grade custody and safekeeping with our custodian Edmonds. So complete separation of your trust assets between us and InvestNow and the custodian. So that kind of brings us to the end of our slides.
Why don't I just fire through some of the questions as they stand now, Jason? I know someone asked who doesn't like pies. Well, everyone does, I think. Well, I certainly do. I've always been a big fan of them. In terms of it, is the $10,000 income before or after expenses? I'm not sure in terms of that question. As I said, I think it's largely irrelevant though, because most trusts are going to fall into having material levels of income. Do you know the answer to that?
Anthony. Yeah, so I saw that part on the TV paying off. So it's after expenses, Anthony. So yeah.
Okay.
But like you said, it's probably not going to be a massive, quantum for a lot of people, right? It's but yeah.
Someone asked what I mean by discretionary investments. I mean the difference between here we want to separate out as a concept family trusts that own a real business or a farm or a building versus those family trusts that also own things like investment funds or direct share, like listed shares or fixed interest security and term deposits. Because if you've got a family trust with real assets in it, like a business, you can't move that into a pie, so you're going to get caught up in these new tax rates anyway. Okay, and so that's what we meant by discretionary investments, just things that weren't real businesses or properties inside of that. In terms of if you're a beneficiary on say 17.5%, can you claim the 28% for the pie tax on the trust? The answer I think to that is no, because then we're actually treating the 28% as being taxed as trustee income as opposed to beneficiary income inside the trust. And in that case, of course, the pie tax wouldn't be going into beneficiary's final income position, and it's a key thing too. The pie is a final tax, so it's not going over into it. Great question in there, Jason, for us is: do you think the 28% pie rate will get adjusted up? And I'd say that will definitely. Right? Yeah. Well, look, the original reason, it's fascinating. People often ask me, well, hang on, why was there this funny tax rate of 28% put in the first place? And it actually worked like this: is back in the day, the person who designed and sort of, in my mind, the architect of pie was Dr. Cullen, right? And in the lead up to KiwiSaver, he recognised that we needed really good fund structures operating for investors, and whoever came up with this concept of a pie fund was quite genius. I reckon it's one of the better investment fund designs that I've seen anywhere in the world, and that's sort of like funds are one of my pet sort of, I don't know, interests and topics. So because the way to pie funds work, for another day and another presentation, they're fantastic. And so Cullen came up with that, and at the time the top tax rate was, I think it was 33, and it was, I can never remember who, so Treasury or the Reserve Bank, whoever the policymaker ones are, said, oh, Dr. Cullen, we have a savings problem. We need to have lower tax rates in these new pie funds to encourage people to save. to try and get over our savings problem, because we've got an aging population and we need a big pool of savings to support it. And that's where it came from. It was an unashamed tax incentive to try and get people to save more. Now, to change that tax benefit is quite a political topic, because you're then turning back around on the same sort of concept and taxing people like KiwiSaver investors a whole lot more inside it. So all those people in KiwiSaver who are on top higher tax rates would be subject to greater tax on that KiwiSaver pool of investments. So that's quite a political topic in itself, where people might feel aggrieved that they've been good citizens, saved into their KiwiSaver, and then sort of trapped into paying more tax on top of that. So yeah, I think changing it will be probably a little bit more political, and it'll need more thought than just waving the flag at it.
Yep. So it's almost like a entire pie tax reform as well, Anthony,
Yeah.
right? And then there's fifth stuff to consider as well. So yeah, it's a very you're opening can of worms, right?
What do you see? I know you had a slide on the sort of differences that you haven't shown, Jason. Someone asked, what are the possible downsides of shifting to pie funds? Why don't you could almost talk to your slide on that, Jason, just to give a bit of
Yeah,
colour.
sure. Let me know if you guys can see the slide again. But yeah, so figure this might be a question. So here we just wanted to quickly highlight, the differences between investing via pie funds versus going direct. So, the difference between investing into a direct Apple, uh, share, or direct New Zealand government bond, or buying into a term deposit directly versus getting the same exposure to those assets but within a pie fund. So obviously the big one that we've already highlighted is the difference in the tax rate. So 39 versus going direct versus 28 for a pie. Pie funds have the benefit of this all being managed by a professional fund manager. So every single pie fund needs to have a licensed manager to looks after your money. Whereas some direct investments, you are basically open to your own time and expertise for managing those funds. So whether it's term deposits or specific bonds and shares, it's all up to you unless you pay kind of a
I'm not sure if Jason froze or I froze, so I think, can someone just note if they can hear me? Hopefully they can. Yes, cool. So it's Jason that froze. That's all right. Essentially what Jason is saying is that the difference between a pie fund is that pie funds is just a professionally managed portfolio of assets wrapped into a fund structure to make it easy for different investors to invest in. And so, so that's the key difference. Whereas often people invest directly into things like self-manage their own portfolio of shares, as opposed to using a professional investment manager to manage it for them. So that's really the key difference. I know someone asked, are there managed funds that are not pies? Yeah, there is. You can have, or is there? You can have different sorts of pies, but certainly you can have a listed pie versus a normal one, but most managed funds, KiwiSaver schemes, are pie funds. Jason, welcome back, or he disappeared. Someone said pie funds can penalise people whose income drops, and that actually is right. Your PIR rate, which is your pie tax rate, is based on your last 2 years of earnings. So you'd probably want to be careful just to check your PIR rate in the situation where your normal income drops quite a bit, which is like the year in retirement, which can be a little bit of an issue. I've never really thought about that, Barbara. There are some real massive benefits. So I still reckon people often don't understand pies enough. I know in my own circumstance, my wife doesn't have, or she's got a very low level of normal income because she only does a bit of, normal type paid work. And in her case, even though she's on the lowest tax rate of 10.5%, the actual rules say that she can earn up to $48,000 of pie income, provided that the normal income she earns doesn't exceed like the bottom tax threshold. So as long as it doesn't exceed whatever it is, $14,000, she can earn up to a grand total of normal income plus pie income of 48,000. So if we just, to keep the math simple, assume that she's got no normal income, for her to earn $48,000 of pie income means that she needs to have roughly about $1 million of assets in her name. So she could have $1 million pretty much invested in pie investments and still get taxed at 10.5%. Now, I'm not sure that that many people have really cottoned onto that benefit. I know in our own case, she's got investments held in pie funds for that very point, and it's all above board. Why Cullen introduced those thresholds was to stop people on lower tax rates getting bumped up an income tax level by virtue of being good citizens and joining into KiwiSaver. So it makes perfect sense why that threshold exists. But, people certainly can be taking advantage of it if they've got low levels of normal income. Another question. Someone said I need better optical glasses because these ones reflect a bit. Yeah, the $2 shop ones are pretty crappy, so I'll take that. Thank you by way of feedback. Yeah, I'll pass that on to my wife because she's always pestering me to go to the optometrist. Yeah, and is there any point in shifting from family? Yeah, I probably didn't make the point strong enough. I think one of the key things that we're going to see is family trusts that now no longer hold discretion. It now no longer holds a business or a real property or a farm. And so those family trusts that say have sold those assets and now are cashed up, I think we're going to see a lot of them wind up. We're going to see two things. We're going to see a number of those trusts move very rapidly in and around 1 April to pie funds, especially when the accountants kick into action as they start thinking about the 2024-25 tax year. But we're also going to see a number of trusts just say, hang on, let's wind up. And so, yeah, we'll see that. Jason, can you have a pie fund exposure just to a single stock? Not typically, right? Because
Nah,
I've
not
got to have a
typically.
diversified portfolio. You could be cute and you can build sort of pie fund structure around it. I think if we look closely at something like some of the KiwiSaver schemes, they do that.
That's what they've done.
So I know how to do it, so to give that outcome. But typically, people who go down this route have gone, actually, I'm quite happy to let a professional person manage my own portfolio. For a different day, we can take you through why we think it's massively challenging to really effectively self-manage your portfolio. But we'll take that into another session.
Yep, diversification is key. It's one of our core investment principles, right, Anthony? So we can go on and on about why you shouldn't just load up on red. At the casino, you got to diversify your eggs a bit.
Yeah, and someone said in there, very few family trusts have cash that they can invest 100% into pie funds. Well, my family trust is 100% invested into pie funds, and if I was sitting on normal direct shares and things, I'd be sitting there going, hang on, this tax change is significant. I want to move quickly to pie funds to capture the 28% tax rate. Yep. Someone said, why would family trusts that do hold real assets also not wind up? Yeah, there's a real protection thing there to consider, like even as a senior manager, director of companies, I've got a lot of liability in things in a personal sense. Under laws like health and safety, my responsibility as a director. So certainly in my case, the family trust provides a number of benefits in terms of separating out the family's assets from me as an individual. And so, it's certainly in not every case would you just want to wind it up because you need to take into account those sort of factors. And a lot of trusts will be like that. Like if you're a senior manager, even within a company nowadays, if you really look at your obligations under health and safety, all those sort of things, different laws, are pretty extreme, are pretty intense, are real. Yeah, does a family trust, Jason, with only PI investments need to send in a tax return? Well, hopefully my tax accountant's watching. He certainly managed to charge me lots for the tax return last year, but it was going through a transition period during that time. I'll be fascinated to see what the answer to that question is, Katie, this year. I assume it still has to return a tax return, Jason.
Yeah,
But
I think so as well, because especially with these new tax disclosure rules, essentially every trust will need to have a whole bunch of reporting. But if you're talking about specifically just the
yeah,
tax on your PI funds, there is no additional obligation you need to work out. There may just be like a, I don't know, like a normal kind of income statement balance sheet that your accountant needs to do
yeah.
for you.
There'll need to be a full set of accounts, but they'll be really basic, is what you're
Yep.
saying, Jason. So,
Yeah.
look, I'll be having that discussion with my tax accountant probably in a couple of months.
Yeah.
Got
Yeah, a
to,
little question about
and
trust and protecting against future partners, future claims. So yeah. Yep.
absolutely. While I'm allowed to say, I know in the case of our own trust, we do things like go through and make sure we document, when the kids come home with different partners and things, we're always quick to say, well, that one's not involved in the family trust, so discount them out. So there's a bit of housekeeping to keep your trust in order, to keep it being, I don't know, from people having claims on it who, could be in relationships with your kids for even a brief period of time. So probably the only thing is to think through that.
Yeah, we had someone chime in the comments. She looks like she's
Yeah.
a tax lawyer, maybe, or an accountant, saying
Yeah.
that you can be excused from filing an income tax return if you only have PI funds. So, Section 43B of the Tax Admin Act, apparently. So, what probably worth highlighting that none of this, what Anthony and I is saying, is financial or legal advice. So, it's
Yeah.
worth
Well,
caveating that.
it's all general, right? If
Yeah,
we can't
it's all
talk about
educational.
people's specific trusts. And Jason, on the InvestNow platform, obviously most funds are PI funds. We do have a
Yes.
small handful of direct term deposits. It's obvious that they're just normal managed bank term
Yep.
deposits because we've got those 6 different banks offering their term deposits through the platform. But when you're inside the platform, it's very obvious which funds are not PI funds, right? Because
Correct. Yeah. So we
5 or
explicitly
6
label them.
Australian unit trusts
Yep. Yep.
actually say they're Australian unit trusts. So
Yep.
very, very easy to see. In terms of how much hassle to set up a family trust on InvestNow, easy. AML side normally takes a little bit of work just because trusts are more complex in terms of understanding exactly who you're dealing with. So it's inevitable that there's those AML type checks to go through. Our team are really good at those checks, and so they make it easy for people. But you have to go through identifying properly who we're dealing with as a trust and where the source of wealth was. The beauty of that is that once you've done that AML check once for the trust, you can access such a wide range of different investments on the platform. So we see that as a real benefit. Did the reading happen, Jason? Did we get to the end? Did you get a result? I take it you're not watching both.
Nah, I've been busy doing this, so we'll find out. I think.
Don't you multitask? Oh my goodness.
Yeah, no,
Hey,
I think we covered a lot today already. So I see there's probably quite a few questions we haven't got around to covering as well.
yeah,
So it's probably worth
yeah.
highlighting if there's any other questions that you guys have. Feel free to
Probably.
just flick
I'll
me an
just
email.
cover off that. I'll just cover off that one that just popped up saying when is the tax paid from a PI fund? Is what happens. PI tax works like this: is that every day the people administering the fund sit down and they figure out all the tax they figure out for the day how much tax is owed by different sorts of investors,
Mm-hmm.
and essentially create a little file that says, okay, for someone investing today, their tax obligation is like 0.000 tiny little bit, but it will be depending on their tax rate. And then that's handed to the people who keep the statement of records for the fund of who all the investors are. And they basically collect that information up, and they typically then pay the tax at a number of different points. So either pay it at the default position is at the end of the year, so 31 March. And so essentially what they do is they say, hey, Jason, on your pie, you owe, say, $10 of tax, and they withdraw that. Basically, they cash up $10 of Jason's units to pay the tax. So it's deferred up until the end of the year. Now, sometimes pies also pay tax if they make a distribution through the year. Now, that's at the discretion of the pie, whether or not it makes those distributions taxable or it just rolls into the year end, or when people withdraw some of all of their money. So there's quite a bit of flexibility as when you pay the tax, but it has to be at least annually. So the investment managers and administrators are running that for you, and it's all seamless and straightforward. And so it just happens against the balance of your investment. Yeah, and that's it for another day topic. I can take people through how pie funds work and just explain it, because I'm probably a bit weird, but I certainly love the sort of mechanics of them. I'm in huge awe of Dr. Cullen for certainly for the work that he did around KiwiSaver and pie funds. Quite extraordinary how brilliant the funds are that came out of it. Probably someone at IRD, but they did a magnificent job. So Jason, shall we wrap up there and let people get back to their days? Thank you for everyone for attending. It was, certainly we hope that it was useful information about how family trust tax rates are changing, but also the benefits that pie funds can provide in terms of the investment returns that you're getting.
Yep. If you guys have any other questions, feel free to send it through to us. I think there was some people asking about the slides, so I don't think we're going to send the slides out by default. I think you get they get a recording by default, but if you wanted the PowerPoint slides, just feel free to email me and I'll send those through to you guys. Yep. So as soon as we finish this call, you guys will get a link to the recording.
Yeah. Awesome. Thanks, Jason. Thanks to everyone who attended.
Thanks, guys. Catch you next time.